Well, what is going to happen to your mortgage, your credit card debt, your stock portfolio, and your crypto portfolio as the US 10-year yields have hit a 16-year peak? What does this mean? Find out now. Now, if you've been following me, I've explained this many times before that I don't think the Federal Reserve is doing what they call a pivot, where they pause interest rate hikes and then they start cutting, thus a pivot. I've been saying that the Federal Reserve is likely to do what is called higher for longer, right, until a major crisis happens. And that doesn't just mean the overnight interest rate goes up, it also means the US 10-year and 30-year interest rate goes up. And that's what it matters for mortgage and credit cards. See, right here is the US 10-year Treasury yield, and that's a crucial benchmark, right? Everybody on Wall Street, guys like even Warren Buffett, uses this to value companies. And now look at it, it's already at 4.5%, which is a major blow to the valuations of a lot of companies on the S&P 500 and especially the NASDAQ. The reason why is because they need to use this 10-year Treasury rate to discount all the future cash flows and earnings from these companies. Put simply, if the safest investment out there, the risk-free rate from the US government treasuries is 4.5%. Then the returns on those NASDAQ and S&P 500 stocks needs to be a lot higher in order for it to be attractive. Do you see what I mean? So the higher this rate goes, the lower the valuation or the stock price of the S&P 500 or the NASDAQ needs to come down. It doesn't happen overnight, but eventually this is something that's going to threaten the markets, and including crypto and Bitcoin as well. But what happens with the mortgage rate? As we can see here, this is the US 30-year Treasury government bond yields, and it's also had a major spike. It's now almost 4.6% now. But what does that mean for your average mortgage rate? Once again, the higher the US 30-year Treasury yield goes, then the higher the 30-year mortgage rate goes for the average citizen, because 4.6% is what the US government is paying over the next 30 years. So if you're an average citizen and your risk of defaulting and not paying back that loan is obviously much higher than the US government, in theory, then the rate you pay is going to need to be a lot higher. In fact, the 30-year mortgage rate right now for a lot of US citizens is something like 7.6% and could go to as high as 8%. Now imagine this, just last year or 15 months ago, the US 30-year mortgage rate is something like 2.9, 3.1%, and now it's at 7.7, 8%. What do you think then happens to the US housing market? What do you think then happens to the US stock market, because so much depends on housing? And of course, I was the one who has been warning since late May or early July again and again, saying that the US 10-year bond yields are breaking out of a bull flag, right? And this was in my Discord, this was in my Twitter as well. What happens next? Follow Pablo for more updates.